Hello and welcome to the ABCs of Trading. We're going to jump right in with a definition of securities. Securities in general are written, legally confirmed certificates through which its holder is granted the right to defined income. It's important to remember that in acquiring the securities, we do not receive a guarantee, but only a right to any material goods in the future. Therefore, in the world of valuable papers, that is, in the financial markets, we permanently face defined risk, because the right itself does not guarantee to us this income. Now let's take a look at the types of risk. The first we're going to look at is business risk. This is connected directly to the company whose securities an investor might own. Companies sometimes encounter problems such as weak management, mismanagement, strategically incorrect business plans, competitiveness in the market sector, etc. As a result, a company may bring a small profit, no profit, or suffer a loss. A consequence of such problems will be that the market value of this company's securities will fall, and an investor will lose money. The next, diversification risk. Many beginning traders often don't have sufficient funds to buy the securities from a lot of different companies. This increases diversification risk. If the value of a security falls sharply, and this security makes up practically an entire portfolio of an investor, the losses can be overwhelming. However, when an investor owns the securities of several companies, which represent various sectors of business, the falling of one security's value can be compensated for by the growth of another. This reduces the risk considerably. The next, liquidity risk. There may come a time when it's necessary to sell securities. In some circumstances, though, it's not that simple if on the given security there isn't sufficient demand. Not sufficient demand, it's failed to be sold at the price desired. The next is purchasing power risk. Money, as well as securities, can lose its value. This is due to inflation. Now, an example of inflation would be that if we were to go to a store today with, say, $10, we might be able to buy 10 loaves of bread. However, with inflation increasing, We go to the same store 1 year later, again with $10. This time we can only buy 5 loaves of bread. So, as inflation increases, the value of money, or what it can buy, decreases. The rate of inflation is fixed by a Consumer Price Index, or CPI, which is calculated monthly by shopping for a specific basket of goods and services that reflect the current lifestyle of the typical American consumer. It includes food, clothing, transportation, healthcare, and entertainment. Now let's take a look at a table. The Consumer Price Index for the period from 1982 to 1984 has an accepted value of 100. All subsequent data is related to this figure. Now, the CPI is comprised of 2 groups. The first group, CPIW, takes into account the buying power of urban families, whose main source of income consists of wages. CPIW consists only of urban households whose primary source of income is derived from the employment of wage earners and clerical workers. The second group, CPIU, reflects the purchasing power and habits of a wider social group and takes into account the economic indicators included in the first group as well as salaried workers, the self-employed, retirees, and the unemployed. Now, what does the number 161.5 mean in relation to the November 1997 CPIU? Well, it means that prices on the goods used to calculate the CPI have increased by 61.5%. These are the things that need to be borne in mind when considering an investment. The more that inflation increases, the less the money can buy. Hence, purchasing power risk. Moving right along, we're going to take a look at interest rate risk now. Interest rates apply to various lending situations, and each situation carries its own form of interest rate risk. The interest rates are comprised of Treasury bills. This is the interest rate the U.S. government pays to investors who purchase Treasury bills. The discount rate. This is the rate the U.S. Federal Reserve System charges its member banks for loans. Commercial papers. This is the rate paid by a corporation on its high-quality short-term debt. CDs, or certificates of deposit. This is the rate paid by commercial banks or thrifts to an investor who lends them money for a fixed period of time. Federal funds. This is the interest rate for overnight loans among commercial banks. Broker call loans. This is the rate charged to brokerage firms by banks for loans using securities as collateral. And finally, the prime rate. This is the interest rate banks charge their best and most reliable clients. Now, what are the risks related to these various rates? Well, they're quite diverse. For example, let's say the Federal Open Market Committee increases the rate on federal funds. This immediately impacts the price of fixed income securities, i.e. the liabilities of the state and corporations. With the increase of the rate, the price of these papers proportionally decreases. Now, all interest rates are interdependent. So the rise of the rate on federal funds automatically results in the rise of all other rates. So let's assume that the rate of the broker call loans will increase. How does this impact the individual investor? Well, the broker will charge the individual investor more for loans they make. Another example would be that the prime rate increases. This means that companies will be forced to take money from banks on credit having higher percentages. This will be reflected in the production costs of these companies, and as a result, lower their income. This finally leads to the drop in price of the company's stock. Now, the last two types of risk we're going to look at firstly, political risk. This form of risk is mainly associated with companies having operations in politically unstable environments, such as South America, Southeast Asia, or Eastern Europe. And the last, taxation risk. Basically, any change in tax policy will be reflected in the incomes resulting from investment. Now, that can be a positive impact or a negative impact. I think more often than not, we deal with capital gains tax and also income tax. Now, that totally depends on what form of investment we're dealing with. Those are the primary forms of risk associated with investment in securities. Securities differ regarding their degree of risk. There are some types which have minimum risk. For example, Treasury bills. And yet others which are very risky, such as options. The answer as to which security to invest in depends on a personal comfort level with the associated risks. Now, a very important rule to remember. The more risk associated with the security, the greater its potential yield. The less risk associated, the smaller the yield.